There comes a moment in every great campaign when the market stops whispering and starts shouting, when the quiet accumulation beneath the surface erupts into a full-scale markup. It's that electric instant when the professionals, who've been silently scooping up shares while the crowd sleeps, suddenly pull the curtain and reveal their hand. The price explodes, volume surges, and the uninformed rush in too late. I've seen it time and again. It's the moment when patience transforms into profit. The Wyckoff Markup Strategy is not just about catching this explosion, it's about recognizing the calm before it. Imagine turning a $1,000 position into $10,000, not through luck, but through precision, by reading the footprints of smart money as they move from stealth to spectacle. That, my friend, is the Accumulation Explosion Setup, where quiet confidence meets calculated timing, and where the few who truly understand market behavior write their own fortunes, while the rest chase shadows. Ladies and gentlemen, traders and students of the market, welcome. Today, we step into the quiet corridors of price action, where true wealth is built, long before the public ever notices. We're going to talk about the Wyckoff Markup Strategy, a blueprint of how the smart money engineers those explosive rallies that seem to come out of nowhere. You've seen it before. A stock drifts sideways for weeks, volume fades, interest dies down, and then suddenly, like a coiled spring, it erupts upward, leaving everyone wondering what they missed. That's not random, that's design. That's accumulation transforming into markup. In this session, I'll show you how to recognize that silent preparation phase, the calm before the storm, and how you can ride that explosion with timing and confidence. Jesse Livermore once said, "The big money is not in the buying or the selling, but in the waiting." The Wyckoff Markup Strategy teaches exactly that kind of patience, the art of seeing what others ignore, of positioning before the headlines, and of turning small capital, say $1,000, into $10,000, not through gambling, but through understanding. So, open your charts, clear your mind, and let's dive into the rhythm of the market, where accumulation meets opportunity, and where those who study the tape write their own success stories. The Wyckoff Markup Strategy is one of the most powerful yet misunderstood phases of market movement, a stage where all the preparation, patience, and analysis finally pay off. Named after Richard D. Wyckoff, one of the great pioneers of technical market theory, this strategy focuses on identifying the transition from quiet accumulation to an explosive uptrend engineered by professional money. To understand it fully, one must think not like a retail trader chasing price, but like the composite operator, the invisible hand guiding the market. In the Wyckoff methodology, the market moves in 4 distinct phases: accumulation, markup, distribution, and markdown. The markup phase is the second stage, the powerful, trending advance that follows a long period of accumulation. During accumulation, institutions quietly build large positions at bargain prices while keeping the public disinterested. When they've absorbed all the available supply, the market is primed for an upward explosion. That's when the markup begins fast, forceful, and fueled by demand exceeding supply. What makes the Wyckoff Markup Strategy so special is that it allows traders to enter before the crowd during the final stages of accumulation. By studying price structure and volume behavior, a trader can identify signs of strength, such as a spring, sign of strength, SOS, or back up to the edge of the creek, BUEK, that signal institutional buying pressure. When these patterns align, the markup phase is imminent, offering an opportunity to ride the trend from its very birth. The markup itself unfolds in very multiple waves, often punctuated by reaccumulation phases, where the market pauses before resuming its advance. Each wave represents another cycle of professional buying, profit-taking, and renewed strength. For the disciplined trader, This creates multiple entry opportunities within the larger trend. Wyckoff emphasized that understanding why the market moves is far more important than simply knowing when it moves. The markup is not just a bullish move, it's the public's late realization of what the professionals already knew weeks ago. A well-executed Wyckoff markup strategy blends both analysis and psychology. It teaches traders the patience to wait through the accumulation, the courage to act at the breakout, and the discipline to hold through inevitable corrections. The goal isn't to catch every tick, it's to capture the essence of the move, the meaty middle of the trend, where the probability is highest and the risk is lowest. Imagine this. You study a stock that's been trading quietly between $10 and $12 for months. Suddenly, volume surges as price breaks $12.50, then retests it successfully. That's not random, it's the ignition of markup. A trader applying the Wyckoff markup strategy recognizes the footprints of smart money and rides the wave from $12.50 to $20, $30, or even higher, multiplying capital several times over. In essence, the Wyckoff markup strategy isn't just a setup, it's a mindset. It's about thinking like the professionals, reading the hidden language of supply and demand, and positioning yourself before the crowd. Master this strategy, and you're no longer chasing opportunity, you're anticipating it. The accumulation phase trading setup is the hidden foundation of every major bullish trend in the market. It's the quiet battlefield where the smart money operates in secrecy, buying from the impatient, the fearful, and the uninformed. This phase represents the professional's preparation before the grand markup begins. To the untrained eye, it looks like a dull, sideways range. But to the educated trader, especially one who studies the Wyckoff method, it's a treasure map pointing toward the next major explosion in price. The accumulation phase occurs after a prolonged downtrend or markdown. At this point, public sentiment is at its lowest. Retail traders are frustrated, and news headlines are negative. Prices appear to have no life left in them. But beneath that calm surface, something powerful is brewing. Institutional traders, banks, hedge funds, and composite operators begin quietly absorbing shares from weak hands. Their goal is simple: build large positions without significantly raising the price. During this phase, volume and price behavior become the trader's most valuable clues. As Wyckoff taught, the market reveals its intentions through its own action. You'll often see decreasing volatility, a drying up of volume on down moves, and sudden bursts of buying that fail to break resistance. These are footprints of accumulation, evidence that strong hands are slowly gaining control, while the weak are selling out of fear or boredom. A classic accumulation phase trading setup follows a specific structure. 1. Preliminary support. PS. The first sign that selling pressure is being absorbed. Volume spikes as professionals begin buying. 2. Selling climax. SC. A sharp, emotional sell-off that marks the point of maximum pessimism. 3. Automatic rally, a swift rebound that defines the upper boundary of the range. 4. Secondary test, a retest of support on lighter volume, confirming the strength of demand. 5. Spring or shakeout, a final fake breakdown designed to trap bears and absorb the last of the supply. 6. Sign of strength, SOS, and backup, BUEKI, the final confirmation that the markup is beginning. Recognizing these stages allows traders to position themselves before the breakout, when risk is low and reward potential is massive. Secret lies not in predicting the market, but in interpreting its behavior. When volume confirms strength and price begins making higher lows within the range, the market is sending a clear message. Accumulation is complete and markup is imminent. Patience is vital here. The best traders wait for the market to show its hand. The accumulation phase trading setup rewards those who can remain disciplined, avoiding the temptation to jump early or follow the crowd. When the breakout finally comes, with volume expanding and resistance shattered, the move can be explosive, often multiplying capital several times over. In short, the accumulation phase trading setup is the art of aligning yourself with the professionals. It's about learning to see what others ignore, to detect strength in silence. Those who master this setup don't chase rallies, they anticipate them, and in doing so, they position themselves where true wealth is created, at the very birth of the trend. The smart money trading strategy is the art and science of aligning your trades with the movements of institutional investors, the real market movers. In every market, there are two groups, the crowd and the professionals. The crowd reacts, the professionals anticipate. The goal of the smart money trader is to study the footprints left behind by institutional activity and move in harmony with them, not against them. This philosophy is at the very core of the Wyckoff method and every great trading campaign, from Jesse Livermore's era to modern times. When we say smart money, we're referring to the large financial players, investment banks, hedge funds, and market-making institutions who have the capital and influence to quietly accumulate or distribute massive positions without revealing their intentions outright. These players use sophisticated methods to enter and exit positions gradually, disguising their activity within normal market fluctuations. However, no matter how skillfully they operate, their actions inevitably leave clues in the price and volume data. The smart money trading strategy is all about recognizing those clues before the public catches on. A key principle of this strategy is understanding market phases. Smart money doesn't chase trends, they create them. First, they buy during the accumulation phase, when fear dominates and prices are low. Once their positions are built, they drive the market into the markup phase, allowing public enthusiasm to push prices higher. Then, as the crowd rushes in, they quietly begin distributing their holdings into strength, setting the stage for the next markdown phase. This repeating cycle of accumulation and distribution is the heartbeat of the market, and the smart money trader learns to ride these waves instead of fighting them. The tools of this strategy are simple, yet profound: price action, volume, and structure. When you see price holding strong on declines but rising with expanding volume, that's not random, it's accumulation. When you see price climbing on weaker and weaker volume after a long advance, that's distribution. The market speaks in these subtle patterns every day. Few listen closely enough to understand. Implementing the smart money trading strategy requires both skill and patience. Traders must learn to think like professionals, to analyze why the market is moving, not just how. A smart money trader doesn't get distracted by news headlines or emotional impulses. They follow the logic of supply and demand. They wait for confirmation, such as a breakout following a period of absorption, and then act decisively, holding through temporary pullbacks as long as the market structure remains healthy. Imagine spotting a stock that's been quietly building a base for months. Volume begins to increase on up days, and the price refuses to break lower despite bad news. The crowd sees nothing, but the smart money trader knows what's happening: accumulation. When the breakout comes, they're already positioned. That's the edge, being early, prepared, and disciplined. In essence, the smart money trading strategy is not about chasing signals, it's about reading intentions. It's a mindset shift from reaction to observation, from emotion to logic. When you trade alongside the professionals, not against them, the odds tilt in your favor. You stop being part of the crowd and start becoming part of the plan. The Wyckoff method is more than just a trading system, it's a complete philosophy of market behavior, rooted in logic, observation, and the timeless principles of human psychology. Developed by Richard D. Wyckoff, in the early 1900s, this method remains one of the most accurate ways to read market intentions, identify institutional activity, and trade in harmony with the smart money. When fully understood, the Wyckoff method transforms how traders see charts not as random price fluctuations, but as an unfolding story of supply and demand. At its core, the Wyckoff method is built around three fundamental laws. 1. The law of supply and demand. This law dictates that when demand exceeds supply, prices rise. When supply exceeds demand, prices fall. Every price movement is simply the reflection of this ongoing struggle. A trader's job is to recognize who is in control, buyers or sellers, by studying volume and price behavior. 2. The law of cause and effect. This principle explains that a period of preparation, the cause, will always lead to a corresponding market movement, the effect. For example, during accumulation, institutions quietly build positions, the cause, which eventually leads to a powerful markup, the effect. The longer and more structured the accumulation, the greater the potential move that follows. 3. The law of effort versus result. This law helps traders measure the market's internal strength or weakness. When large volume, effort, produces little price movement, result, it signals hidden absorption or distribution. This law reveals when the market's energy is being stored for an explosive move. The Wyckoff method organizes the market into four distinct phases: accumulation, markup, distribution, and markdown. These cycles repeat endlessly, driven by institutional behavior and public emotion. During accumulation, professionals quietly buy while the crowd sells in despair. During markup, prices rise rapidly as demand overwhelms supply. Then comes distribution, when professionals unload their holdings onto the euphoric public. Finally, markdown begins a controlled decline that punishes late buyers and resets the market for the next cycle. One of Wyckoff's most powerful contributions is the composite operator concept, the idea that the market should be viewed as if it were controlled by one highly intelligent entity, managing large positions. By studying how this composite operator accumulates, marks up, distributes, and marks down, traders can align their actions with the professionals rather than against them. The Wyckoff method also provides clear tools for analysis, schematic patterns, support and resistance zones, and volume-price relationships. Wyckoff traders use these tools to identify springs, signs of strength, SOS, and backup tests, BUSI, signals that confirm the transition from accumulation to markup or distribution to markdown. This systematic approach eliminates emotional guesswork and replaces it with logic and probability. Ultimately, understanding the Wyckoff method allows traders to see beneath the market's surface. It teaches that price movements are not random, they are deliberate. They reflect the footprints of powerful players operating under timeless laws of human behavior. When you trade the Wyckoff way, you stop following the crowd, you follow the truth written in the tape, and that's where consistent success begins. The dream of every trader is simple, turning a small account into a substantial fortune. But while most chase quick profits, few understand that sustainable growth comes from structure, discipline, and timing. The turn $1,000 into $10,000 trading plan isn't a fantasy. It's a roadmap based on principles that masters like Jesse Livermore and Richard Wyckoff lived by. It's about multiplying capital through calculated moves, not reckless bets. About compounding small edges into exponential gains. At the core of this trading plan lies risk management. You cannot grow an account if you cannot protect it. Every trade must begin with a defined risk, never more than 1–2% of total capital. With a $1,000 account, that means risking only $10, $20 per trade. This discipline ensures survival through losing streaks, which are inevitable even for the best traders. The secret is not avoiding losses but managing them, so they don't cripple your ability to trade another day. Next is strategy selection, and here the Wyckoff framework offers a perfect edge. By focusing on accumulation and markup phases, traders can position themselves early before the public rushes in. This allows for asymmetric risk-reward setups, where a small, low-risk entry can yield massive returns. For instance, spotting a spring at the end of an accumulation range could offer an entry where a $20 risk might lead to a $100 or even $200 gain a 5-10x reward-to-risk ratio. That's how small accounts grow through precision entries and patience, that turn $1,000 into $10,000. Trading plan also depends on compounding profits, not withdrawing them prematurely. Each win increases your base capital, allowing slightly larger position sizes over time without increasing risk percentage. This is the mathematical engine of growth, where consistency, not size, multiplies wealth. A 5% average monthly return, compounded over 2 years, transforms $1,000 into over $2,700. Push that edge to 10% per month with disciplined execution, and the same $1,000 grows to over $8,900 in that time. The magic isn't luck, it's mathematics powered by consistency. Another critical pillar is emotional control. As Livermore often warned, emotions are a trader's worst enemy. Fear causes hesitation at the right moments. Greed blinds judgment at the wrong ones. The disciplined trader sticks to the plan, entering at technical confirmations, exiting at predefined targets, and never chasing impulsive moves. Patience and emotional neutrality turn trading from gambling into a business. Finally, the trading journal is your personal blueprint for improvement. Document every trade entry, exit, rationale, and outcome. This transforms mistakes into lessons and patterns into profit. Over time, you'll refine your execution, eliminate emotional decisions, and identify which setups deliver consistent results. In truth, turning $1,000 into $10,000 isn't about secret indicators or overnight success. It's about mindset, management, and mastery. When you combine the Wyckoff understanding of market structure with disciplined money management and psychological control, you no longer depend on luck, you rely on logic. The result? A trading plan that doesn't just grow your capital, it grows your skill, confidence, and consistency. That's how small traders become professionals. As we close this journey through the Wyckoff Markup Strategy and the art of trading like a professional, remember this: the market is not a place of chance. It is a reflection of human behavior, repeating in rhythm and emotion across generations. The true trader's edge lies not in prediction, but in perception, the ability to see the silent footprints of smart money and to act before the crowd awakens. The Accumulation Explosion Setup is not just a trading pattern, it's a philosophy of patience and timing. It teaches us that wealth is built in the quiet phases, the moments when others are fearful, distracted, or disinterested. It is in those periods of accumulation that the seeds of fortune are planted, and when the markup finally ignites, it rewards only those who had the courage to prepare early. The Wyckoff method gives us the language to interpret these market movements, the laws of supply and demand, cause and effect, effort and result. The smart money strategy reminds us to move with the tide of professionals, not against it. And the $1,000 to $10,000 trading plan proves that with discipline, risk control, and consistent compounding, even small capital can achieve extraordinary growth. Jesse Livermore once said, "The market never tells you what to do, it shows you what to do." The difference between success and failure lies in whether you're willing to listen. The Wyckoff Markup Strategy is that listening skill. It's how you hear what the market is whispering before it begins to roar. So, as you step back into the market, don't chase the noise. Study the structure. Observe the volume. Recognize the story behind the chart. Trade with patience, conviction, and respect for the laws that govern all price movement. Because in the end, trading mastery isn't about prediction, it's about preparation. And those who prepare with understanding will always be ready when the next accumulation turns into an explosion. That is how legends are made. That is how you turn knowledge into power and a $1,000 beginning into a $10,000 victory.